Hello everybody, welcome to the CEFC Green Room, where today we're going to discuss the topic of can private equity drive the transition to net zero emissions. My name is Rory Lonergan and I'm your host for today's webinar. Before we start, firstly, I'd like to acknowledge the traditional owners and custodians of the land where I'm based today, the Gadigal people of the Eora Nation, and pay my respects to their elders past, present and emerging. For those of you who don't know me, I'm an executive director at the CEFC, where I lead our infrastructure and broader equity platform. So I look after a range of asset classes, one of which is private equity, which is the topic of today's conversation. Specifically, I think we're going to focus on decarbonisation and the impact and the contribution that the private equity sector, the participants in that, the investors, the fund managers, and indeed probably most importantly, the management teams at the asset level can have on decarbonisation of their assets and the impact of that and the opportunity for that across the broader economy. When we look at where the national emissions come from, it's very obvious that a very, very significant portion of the emissions come from companies and assets that do not sit in the ASX 200 or 300. So nationally, we have emissions of over 500 million tonnes per annum. So there's a very significant chunk of emissions sitting in assets that are the subject of today's conversation. The CEFC has been investing. It's a relatively new investor, I suppose, in the scheme of things in private equity. We've been investing in the sector for a couple of years now, and our first investment into the private equity sector was a cornerstone investment in the Adamantum Capital Fund number 2, which was, I think, certainly at the time, was the first private equity fund to adopt what we described as, and what the manager Adamantum described as a cradle-to-grave approach to the task of emissions and decarbonisation. To discuss the changing landscape of private equity as we transition to the net zero emissions economy, I'm joined today by 3 experts in the private equity field. They are Rob Kosker. Welcome, Rob, who's a managing director of Adamantum Capital. His experience spans private equity, public company directorship strategy, and social impact investing. Rob was previously CEO of Social Ventures Australia and a managing director of Pacific Equity Partners, and also serves as the chairman of Social Ventures Australia. So welcome, Rob, and I'm sure you are well known to many of the people dialing into today's call. Natasha Morris is a colleague of Rob's and is an integral part of the emissions and decarbonisation story at Adamantum. She's the director of responsible investing at Adamantum Capital, and she has over 15 years of experience across social and private sectors, both in Australia and the UK. And prior to joining Adamantum Capital, Natasha spent nearly 10 years in the social sector, working across impact investing operations, strategy and venture philanthropy. Welcome, Natasha. And lastly, we have Andrew Major. Andrew, again, is probably well known to many people on this call as the Chief Risk and Compliance Officer at HESTA, responsible for HESTA's risk and compliance team. He's also, very importantly for this discussion, a former chair of the AIC, the industry body representing the private equity sector, private capital sector in Australia. He's also served as the co-chair of the UNPRI Infrastructure Advisory Committee, director of Climate Bond Standards Board, representing the investor group on climate change, and as HESTA's appointee on numerous fund advisory boards. So welcome, Andrew, and thanks everybody for joining me, and really looking forward to the discussion. Just quickly, some housekeeping before we get started. Today's formal session runs for about 30 minutes. That's the panel session, I suppose, for those of you who are familiar with attending conferences, followed by about 10 minutes of Q&A. You can ask questions in the Q&A box on the screen, and time permitting, we'll attempt to answer at least some of the questions that we have on hand. At the end of the webinar, there will be a questionnaire which will appear, and as ever, we would appreciate your feedback to improve these events in future. This is one of a series of these green room events that we've run over the last couple of years on various topics. So we're very keen to keep improving how these operate so that people can get the most value from it. So welcome everybody, and welcome to everybody online, and thank you for taking the time to dial into this. I know everybody's very busy, and taking time out of your morning in particular to join us is very much appreciated. We might get into the conversation, the panel aspect of it now, and maybe we'll start with a fairly broad question, which is, I suppose, to all of the three participants, which is, at the end of last year, we had COP26 in Glasgow, the Conference on Climate Change, which was attended by a very large number of people. There was a renewed focus, I think, there on achieving net zero, and a lot of energy, if you'll excuse the pun, to drive a lot more urgency around the task of decarbonisation. For me, one of the most interesting things that came out of that was the conclusion that we need to reduce emissions by 50% by 2030. Right? So not just a focus on decarbonisation by 2050, but setting some shorter term goals, which I think are very important. Interested to hear the panel's views on how the market has taken that on board, or whether, as happens after many conferences, it's now back to business as usual. So I think it's a little bit of a state of play question. So maybe I'll throw to all three panelists. Maybe I'll start with Andrew, perhaps, if that's okay, for a broader multi-asset perspective, and then maybe Rob and Natasha, you could offer a view from the private equity perspective.
Thanks, Rory, and thanks everyone for joining. It's really great to be here to have this discussion. I think the business as usual question, I feel like that for super funds and institutional investors generally, the new business as usual is a decarbonisation objective. I think with a lot of the bigger super funds here and other investors overseas announcing stated intentions to transition to net zero over time, and particularly by 2050, that has become the new normal for us. And that is the objective that we are trying to work towards across our broad portfolio. So, as Rory said, in a multi-asset portfolio, you have to be thinking about what levers you can pull in your equity, listed equity strategies, your credit strategies, your private and unlisted market strategies, and there needs to be a connection across the whole of the portfolio around achieving those objectives. And it's not easy. It's a path that I know we at Hester started on several years before COP26, and it's a path that is effectively front and centre of our investment strategies as we go forward.
Yeah, Andrew, I'd say in the conversations that I have with our investors, we're definitely seeing a movement to incorporate net zero into their investment strategies increasing. We raised our second fund, the one that Rory mentioned, CEFC participated in. We started that in conversations in 2019, at the first close in 2020. And it was noticeable at that point how much more front and centre consideration of climate strategy, decarbonisation strategy amongst broader ESG issues had become in the 3 years since we raised our first fund in 2016. And even since then, the quality of engagement that we get with investors on these issues has continued to improve. I think it is coming from that end. I think within the broader operating company environment, we see in particular markets, some strong market signals which are driving changes in products and services, but it's not yet broadly accepted across the whole economy, I would say. What we are seeing a lot of receptiveness as we bring those ideas to the table from the teams that we work with to incorporate the ideas into their day-to-day operations. And they do actually see real value in incorporating a decarbonisation agenda into the operations and the products and services that they're pulling together. And Tash, I know that you've had many more specific conversations with investors since COP26. We're very interested to hear your perspective on that too.
Yeah, thank you, Rob and Andrew, and I concur with both of the comments that you made, and I think it is becoming very much, as you said, Andrew, business as usual from the kind of the markets and the investor end of the spectrum to be talking about this decarbonisation. And I think one of the more interesting things to come out of COP26, in addition to the commentary around the emissions reduction, is this notion of the new sustainability reporting framework. And the drive to get some standardisation across that. And I think some of these regulatory and reporting frameworks are supporting this investor push and investor focus on decarbonisation, because as you see TCFD reporting becoming mandatory in jurisdictions like the UK and New Zealand, you saw the US SEC come out last week and announce mandatory climate disclosures. You see APRA and ASIC starting to focus on it in Australia. I think that regulatory context is now really focusing investor attention, certainly in the public markets, on these issues. And you're seeing groups like the IGCC come out and say this is what we expect net zero plans to look like, and this is the standard of Scope 1, Scope 2, Scope 3 coverage and decarbonisation pathways that we are expecting. And all of that momentum in those markets is also what we're starting to see with investors. Investors in our private equity space are kind of looking to those movements and trends in those markets and saying, well, what does that mean in the private equity space? And actually, we want to understand how your businesses are decarbonising, and we don't want that just to be some kind of commitment. We actually want to understand how you're planning to do that, and we want to see those plans, and we want to understand how engaged your management teams are in delivering those plans, and how integrated are those net zero considerations in board discussions and capital expenditure cycle discussions within those businesses. So we're seeing I'm definitely seeing a real movement in our private investor base from understanding the broad concept of decarbonisation, but looking at it and how is it actually relevant to your business and what are you actually doing about it at a granular level is definitely what we're seeing across our investor base at the moment.
Yeah. Rob, decarbonisation, I suppose, climate change and decarbonisation is a systemic risk, right? It's not a short-term risk. There are no short-term fixes. So taking a long-term view is obviously core to meeting this challenge. That works well, I think, in assets such as infrastructure assets or private equity assets, or property assets. Timeframes are a little shorter in the private equity space. So you and your fund talk about a cradle-to-grave approach to decarbonisation of your assets. Can you expand on what that means for your fund, and particularly in the private equity context with those shorter hold periods?
Yeah, well, we certainly hope that none of our investments end up in the grave, but yeah, definitely over the life cycle of our ownership, we want to make sure that the companies are really engaging in this question about how they manage their energy intensity and decarbonise at a sensible path over the life of their experience with us as investors. And there are a few reasons for that, and they actually all end up being quite short-term reasons. Certainly, when you talk to the operating priorities of companies at the moment, are significantly affected by the day-to-day operating challenges that climate change are inflicting on businesses. And we see that from the bushfires, the droughts, the floods, and that's causing all sorts of operational disruptions. We have one portfolio company which has a significant manufacturing facility in Perth, with the rail infrastructure being cut from Perth to the East Coast, meant that they had to create alternative distribution pathways and change their whole inventory model to be able to continue to serve their East Coast customers. That's just one example of many that the management teams all across Australia and New Zealand are having to deal with in response to short-term climate impacts. The connectivity between those short-term challenges and the longer-term need to decarbonise is not necessarily clear from management team perspective, because people generally do get caught up in these short-term issues. But as an investor, from our perspective, it's very clear that there are genuine risks, short and long term, in each business that we invest in regarding climate and carbon, and they're separate risks, and we do think about them separately. But the risks that are unbounded and unmanaged really damage the value of assets. And so the first thing that we do in our pre-investment due diligence is to try and establish a greenhouse emission baseline, so we know how much carbon and what the carbon intensity is of the assets that we're investing in. And we do a TCFD-aligned analysis of the climate risks that are inherent in the business, so we can make judgments as to whether or not those sort of flood, fire, drought type risks are ones that the physical infrastructure of the company can withstand. Having done that, we're then in a position to make management or help management develop plans to ameliorate those risks. And there again, from an investor perspective, a couple of reasons to do it, even in a sort of a 3 to 5 year hold period. Things are moving very fast, and so in a short term, there will be P&L impacts and investment impacts that need to contemplate those questions. But in an exit context, if we roll forward and say we're selling a company that we've bought today in 2025 or 2027, the market sophistication at that point to understand the energy intensity, the carbon intensity of the business, and the pathway to decarbonise, and how the cost of carbon is being managed across the value chain in that industry is going to be much more sophisticated. And if we can help the next owners of these businesses bound those risks and demonstrate an active capability in managing those risks, then that can only increase the value of the asset as we bring it to market. Because instead of presenting something which is theoretical and could be wild and potentially existential, we'll know exactly what it is, and our management teams will be able to talk very specifically about what they're doing to mitigate those risks and take advantage of the opportunities that exist. And I think that's the next phase of a lot of this conversation, is not just about how do you manage risks, but how do we take advantage of opportunities that this is presenting as well.
And I think if I could just add to that, sorry, Rory, in a short-term sense, what we've found, because we've done quite a lot of emissions reduction planning across our current portfolio companies. And what we're finding in that is that even though you are planning for a long-term solution in terms of if it's out to 2030 or 2040 or wherever you're planning out to, actually there are a lot of things that we can do in the short term in our hold period to put those portfolio companies on that pathway that actually have other short-term benefits for those portfolio companies as well. So often when you stare into these things from a decarbonisation perspective or a climate risk or opportunity perspective, it causes you to think about some things that you can change in the business. And some of them are small things. They're about improving operational efficiencies in the business that actually have other flow-on short-term benefits to that business in addition to the long-term decarbonisation benefits. So it's not all that it's kind of a long-term planning for some long-term solution that doesn't have a benefit in the short term. We're actually increasingly finding as we stare into this that both of those things can coexist together in our whole period.
And just to further build on that, it's also not just a pure cost piece. Attracting talent, we can attract talent to organisations if there's a clear statement on environmental sustainability, and attracting customers. Customers are expressing preferences for products and services that are sort of fully abated, zero sort of carbon footprint. And so our management teams are in some situations making decisions to decarbonise far in advance of our sort of promise to our investors, on the basis that there's actually strong consumer and talent demand for that to happen. It drives a competitive advantage.
So you don't see the closed-end nature of the typical private equity fund, or the relatively short 5 to 7 year hold, and as being an impediment to putting in place this journey, this transition.
One of the great privileges that you have as a private equity investor is that you do get to sit in the seat of the owners of the business, which is clearly not us. It's not even Andrew. It's the mums and dads who have their money invested in super funds or in the insurance businesses and so forth. And we have a responsibility to actively manage those companies for the long term and for creating value both for their investors today, but to create value in the businesses on an ongoing basis. You can't create value for the owners of businesses in the future unless you're dealing with these medium to long-term risks. And so we absolutely have to be addressing them up front from the first interactions that we have at the board meetings, because on a 3 to 5 year basis, you don't get many chances to make the right capital investment decisions or the right strategic decisions to address these risks if you don't get to it in the first 3 months of ownership.
Yeah.
And I think, Rory, that the question about it's private equity is a shorter term hold period, so therefore there's not a lot that you can do about it. Is a relatively convenient response to questions about an investor's approach or a fund manager's approach to these sorts of issues. Because as you can see from what Rob and Natasha have been saying, it's complicated, it's hard work, and there are a lot of moving pieces. And what we've heard from both of them is a really mature and a well-considered approach. And it's clear that they spend a lot of time thinking about it and trying to put in place strategies to address the risk and return considerations. And there's probably in the local market not a lot of others who are thinking about these sorts of issues in such a mature way. The short-term nature is convenient, but as Rob says, the industry is a steward of capital, and we are in it for a period of time, and we pass it on to the next group of owners, and we try and build value, build productive capacity, and build economic and social outcomes as it passes through our custodianship.
And I think one thing I would just add to that as well, Rory, is that, your question is the short-term hold period an impediment? No, I don't think it's an impediment. I do think it is a challenge in the context of all the existing tools and frameworks that are out there and that exist to help people try and analyse climate risk or try and develop decarbonisation plans, because they are all set up around this 2050 concept and are much longer term in nature. So it's not an impediment, but I think one of the challenges in it for the private equity space is how do you take those tools and frameworks and use them in the right way in a private equity decision-making context? And that's something we grappled with. Rob mentioned before that we do a TCFD-aligned climate risk analysis on prospective investments. That's something we grappled with when we decided to do that. How do you take that TCFD framework and how do you make it relevant to a private equity decision-making context so you're getting the right insights into the climate risks and opportunities, both for within your hold period, but setting it up for beyond. So I think Andrew's point is right. It's not easy, but it's not an impediment. So, you've got to be up for the challenge, but I think the industry is more than capable of doing that.
Yeah, and we might come back to how investors and managers indeed get rewarded for tackling the challenge. But before we turn there, Andrew, I'm particularly interested to get your view as somebody who has exposure to multiple different types of assets, and the question of sorry, it went dark there. Energy efficient building, turn the lights off when I don't move. That's a good thing, I suppose. Andrew, yes. So the question of different asset classes are different parts of their journey in terms of decarbonisation, property, infrastructure, agriculture. Where do you see private equity today in terms of each?
Yeah, I think private equity is probably a fair way behind other asset classes, to be honest. I mean, property has been focused on energy efficiency. They've got external standards, both at government level and international standards through things like the GRESB. That influences the way that buildings are managed. Infrastructure is kind of coming at it from the social licence perspective, and also from because they're owning and operating large public infrastructure assets that are essential to the operation of economies and societies, and they're building that social licence through the things that they're doing around capturing more efficiencies, reducing costs through introducing renewable power. Some of them can be quite heavy carbon emitters, and they're working out ways to reduce that. And I think that's been a trend that's ongoing probably for the last 5 to 10 years. I think private equity, as I said, is a bit behind, and I think Australia is probably a little bit behind some of the global peers too. When I was speaking to global fund managers, they have significantly invested in resources, in capability, in intellectual property and know-how to drive a focus on these sorts of risk issues in their portfolios. Having said that, they are bigger organisations that invest across a number of asset classes, and so can leverage scale better. But I think it's it's important to see that distinction between a manager that basically invests from a pure return maximisation perspective to one that considers the impacts of decision making and investment returns on society and the economy. So from an AIC perspective, one of the things we've been really conscious on over the last couple of years is building the industry's social licence, or its licence to operate. Every now and again, there's a reputation issue that sort of reduces the reputation of the industry, and we're trying to continue to build that so that if that ever happens again, the knock is not so bad, because we're seen as a responsible investor in economies. It's a work in progress. Some, I think, still see it as maximising return at all cost. But what you're hearing from Rob and Natasha is you've got to balance the risk versus the return. Thinking about how returns are achieved and recognising the need to act in a sustainable and responsible manner. I like the point about how do you leave a company for the next buyer, because clearly a way to create value is the multiple or the value that you can get on exit. And if you're not necessarily addressing what the next buyer is going to be looking for, you might end up with a discount on the exit multiple. You're also seeing, though, on the positive side, companies that are being invested in that are tapping into the trend. And so the managers recognise the trend, the broader trend around decarbonisation, energy value chain, carbon measurement and monitoring as value-adding potential investments in the portfolio. I think it's still a work in progress about how they're actually doing that within their own portfolio companies, rather than buying portfolio companies that are focused on those sorts of trends.
And Rob, in terms of the question of how do investors and indeed how do managers get rewarded, and Andrew touched on it a little bit. Do you have a view on that? You know, it's not unusual for investors, I suppose, to look at some of the investment decisions that have to be made during the life of the period they're holding the asset, and wonder about paybacks, or whether it's IRR accretive or dilutive, or whether it's I suppose whether it falls into the too hard basket, and that question of do I leave it for the next guy? How do you think the hard work gets reflected and rewarded?
Look, at the end of the day, we are rewarded by the financial returns that we make for investors, and there's no stepping back from that, and no desire to step back from that. I think our view would be that the way to maximise financial returns is by actively managing the environmental and social risks which are inherent in every business. I think if you're choosing to invest only in businesses that have very limited environmental and social exposures, you'll have a very, very small investable universe, and you'll probably end up getting no capital deployed. And so in the world that we live in, where those issues touch every operating business in Australia and New Zealand, the only rational response we feel is to build our skills at managing those, seeking opportunities and supporting management teams to take advantage of those situations. And we're learning. You know, the way we talked about this when we raised our first fund is quite different to the way we talk about it now. One of the things that Tash has formalised over the last few years that she's been part of the team has been our overall responsible investing framework, which talks about not only environmental sustainability, but also about participation and transparency. And Tash, you might talk to the measurement framework that we're we're putting in place around all of that over the course of this year. But I think at its heart goes to this question that as you sit around the boardroom table, there are a whole series of investment decisions that get made at every meeting. Should we invest in more sales resource? Should we invest in new plant and equipment? Should we invest in a particular acquisition? And unless you have in your mind that you're operating in an inherently unstable environment where in some businesses, the economics of production, the value of the input into others' supply chain, the cost of carbon, the sensitivity to scope 1 and 2 versus scope 3 emissions is going to change, then the potential to make poor decisions is quite high. And so it's critically important for us to build our own skills and capabilities and set a frame within which management can make the wisest choices possible.
Thanks, Rob.
I think the other point I would make, Rory, the other point I would make just in relation to kind of the exit picture is, you know, Australia doesn't exist in isolation from the rest of the world when you come to exit strategies. And if you're looking, I think someone made the comment earlier about, for example, that Europe is more progressed in some of its decarbonisation strategies and plans than Australia is, for example. So if we are looking to exit one of our businesses to a European strategic player, for example, one of the things they will look at is the greenhouse gas emission intensity of that business. And if they have a decarbonisation target in Europe, which is increasingly becoming more regulated, let alone anything else over there, if our business has a much higher emissions intensity profile, that's something that they're going to discount when they go to buy that business because it doesn't fit with their overall decarbonisation strategy that they've set and invested in their own business. So there's, you know, that's just a really small and specific example, but, you know, that's something that people will look at in an exit scenario.
And maybe one last question for the panel before we turn to some of the audience questions. And it's the question of the private equity sector, as I think we've discussed, is relatively early on in its journey in terms of decarbonisation. If we were to get out the old crystal ball and you know, were to predict where was the industry going to be in 5 years, where would we like the industry to be in 5 years? What do we think that will look like? You know, will reporting frameworks and measurement tools all exist? Will it sit inside some of the reporting frameworks that apply to some of the other well understood globally traded assets, etc., etc.? Maybe I'll start with Andrew first on that, and then maybe go to the Adamantium guys.
Yeah, I think we will see a much bigger focus on carbon awareness from an investor perspective. Those trends that you talk about, Rory, the reporting requirements, the frameworks that we may voluntarily sign up to, or that we may be forced to adopt by regulators and by others, we will then be looking for information and input and analysis and reporting from the fund managers that we invest with and the companies that they invest in. So there is definitely going to be a lot greater carbon awareness at our level and probably more questions and oversight and management from our perspective that would want our investment partners to work with us on and to help us with. I think in terms of a broader, and so there's definitely going to need to be infrastructure developed to allow us to do. We'd also be wanting to see strategies that are capturing value from the opportunity that it comes from decarbonisation. And that's important just in absolute terms in the context of our approach to responsible and sustainable investing, but also in the context of institutional investors like us wanting to achieve that net zero ambition over the medium to long term. We still, as Rob said, we still need to get that risk return outcome right. And so I don't think, we can't sacrifice return for outcome in that perspective, but we definitely will be looking to balance return versus risk. And we'll also be taking a portfolio-wide view on carbon neutrality. So when we have an institutional portfolio that's in 5 years' time, maybe 100 billion plus, that invest broadly across the economy, we know that there's going to be, and the global economy, we know there's going to be pockets where we just can't take carbon out. So we're going to have to be looking for ways to go short in other parts of the portfolio. And that's going to come through in sort of that overlay perspective, what we might do in the portfolio, but we're also going to be looking where we can for investment strategies that can help us get to a lower carbon output and a lower carbon position to support our transition and our stated objectives around the transition.
And maybe if one of the Adamantium guys would like to offer a view, and then we'll move to a couple of audience questions.
I'll go ambitious, Rory. In terms of where I'd like to see the private equity sector in 5 years, I'd like to see us move from what Andrew described before as private equity being somewhat behind some of the other sectors, to have lifted this level of engagement of topic and conversation throughout the entire private equity industry as something that the whole industry is committed to. We control a significant portion of the economy in Australia, and if the private equity sector can commit to decarbonisation being something that sits along being able to deliver outstanding financial returns to our investors and can demonstrate that that can be done, then great. Hopefully we can lead the way, leading the way for other parts of the economy. I think it's really where I'd really like to see it at a practical level is you're sitting around having those conversations in investor presentations and sitting around having those conversations around the board table, and even with some of the younger generation of people coming through the private equity firms, to have these conversations around decarbonisation and environmental outcomes sitting at the same level of conversation that we have around financial outcomes, and showing that you can do both of those things at the same time. And that's certainly where we're trying to drive it from an Adamantium perspective. And we'd love to see the kind of broader industry engagement on that.
Rob, do you want to offer a quick view on that?
I agree. I think the other thing that will come through is a much more consistent reporting framework. We will need to find ways to communicate amongst ourselves, and by ourselves I mean the whole investment community, about carbon intensity, inherent carbon risk, climate risk and other things. There are lots and lots of initiatives going on in the public company space, in other asset classes, and that will only become more sophisticated and will make these conversations simpler over the course of the next few years.
Yeah. I know from my perspective, I very much hope that it's almost that this conversation doesn't have to happen, right? Because it becomes just how you do good business. This is just how you run assets for people, so that it just becomes core. So you almost get to the point where you don't have to have a specific focus on it, but it will obviously take us quite a while to get there. We might turn. We've got about 7 minutes left, so we might deal with a couple of audience questions. I might throw the first one to Rob. These are, I think you've probably seen the questions coming in, so hopefully it's not totally without notice. There was a question about greenwashing, and it's obviously there's been a lot of talk in the media in the last couple of weeks about this topic, and I think it's always a topic on more on the demand side of the energy equation. It's obviously less so on the generation side, but it is something that gets discussed frequently on the demand side, with the financing products that are coming out into the market in particular. Do you think greenwashing is likely to be an issue in the private equity space? Or
I think it goes very much to that last point we were discussing, that from an investor's perspective, it's actually very difficult at the moment to get clarity as to what's actually happening at an asset level around these issues, because except for the CEFC, are clearly taking a lot of carbon intensity very seriously. Turning the lights off every 5 minutes. But it's hard, and as we get better and more consistent reporting, it'll become easier for investors to make choices that reflect the reality of what's going on in different underlying assets. I think there's, if you want to be generous about it, and I'm not entirely sure that I want to be generous about it, then you tend to measure yourself by your intention and others by their outcomes, and I think there is some good intention around there, but it often doesn't really land yet in a meaningful way and create outcomes. I think that's why we spend ourselves quite a lot of time on that measurement, on getting consistent language that we can share across portfolio companies, share with investors, that we're holding ourselves to account to continually improve and demonstrate that we are turning the ambition into outcome. Because I think that ultimately is the way to substantively deal with the concern, is to find the language which is objective and hold yourself to being transparent.
Yeah.
Yeah, if I could add, I think one of the things that we are really mindful of is assessing what's behind the label of an investment strategy. What I've found over my years in investments is that where there's a trend, fund managers will follow the trend and look to put a label on something to try and attract capital. And what we need to do as investors is understand our expectation of what we want, understand the outcomes we want to achieve, and then interrogate strategies based around the position that we have. So it almost requires us to be thoughtful ahead of being approached by these sorts of strategies. And I've found that when you can ask questions based on the view that you've developed, you can then assess the responses, see who's potentially greenwashing and who's really looking to implement a solid strategy that you can get behind.
Yeah, and maybe one last question from the audience, and this is, I think, again open to all of the people on the panel. I think we've talked a lot about the why of decarbonisation and why it's important, and this question I think focuses a little bit more on the how, which is when we talk about decarbonisation, what is the preferred route? Is it a circular economy approach? Is it renewable energy purchases? Is it hard focus on energy efficiency, or I suppose perhaps is it all of them? So maybe Natasha, do you want to start with that one?
Yeah. My answer would be D, all of them. I think it's really, there's not a one size fits all answer to that question, Rory. There's a macro economy answer to that question, is what does Australia as a country have to do to decarbonise? And there's plenty of scenarios and research out there that suggests different pathways, and a lot of that clearly hinges around renewable energy and electrification and all those kinds of things. I think when you're looking at it through the lens of a private equity investor and looking at individual portfolio companies, the answer is it depends on the portfolio company, it depends on its sector. And this is where the really important part of actually the ability to go into those portfolio companies and the first important step of measuring and understanding what their emission sources are, where they come from, which ones are material, is the really important first step in that, because until you understand that piece of the puzzle, you can't then go and figure out how you're going to decarbonise it. So I know across our portfolio, and we're doing net zero plans across 7 portfolio companies, some of which are complete, some of which are works in progress at the moment, and they involve all and any of those things that you just mentioned, Rory. Some of them are we've got our horse feed manufacturing business that is doing a lot of solar panel installation on its factories to power by renewable energy. We've got other businesses that are focusing very much in the next 12 to 24 months on energy efficiency and actually just kind of what we call best practice housekeeping initiatives, which in and of themselves can drive a 10% reduction in emissions reductions in the space of 12 to 24 months. Other businesses have far more challenging emission sources, for example, refrigerants, which are very capital intensive to replace and deal with. So they have longer term strategies about how to replace those. So it really depends on your emission sources. And I think a point that Andrew was making before in terms of the investment in the thematic in this space to bring those technologies to life and bring all of those solutions to the forefront is a very important part of what the industry can do in this space.
Very good. Well, I think that brings us to time, pretty much. So it just leaves me to do the wrap up. Hopefully the lights will stay on for that part. So I'd like to thank everybody for attending in the audience. We had a great turn up and appreciate everybody's time. I know a chunk of time in the morning is particularly valuable for everybody. So I appreciate you sharing some of that time with with us. A big thank you to Natasha, Rob, and Andrew. So for what I think was a really interesting, interactive conversation. So I know I certainly learned a lot, and hopefully our audience got something out of it. So thank you again. So that brings us to the end of the webinar. So it just leaves it to me to wish everybody a good rest of your day, and hopefully we'll all meet up in the flesh at some point. Thank you.